All right, folks, this is being recorded. Something I mentioned at the beginning of every single webinar, like a broken record, is watch this again. The reason why is because some of the nuances I talk about from an options trading perspective might go by you pretty quickly. So watch it again. It'll make some of those nuances sink in, especially if you're a newer trader. Some of you older traders or nuanced traders, this will help you get rid of those bad habits and put in some of those start implementing good habits. All right, now the last section of this course, we went over bullish patterns for setups. Now we are moving on to the bearish moves on these trades. But first, let's talk about swing trades in general and what a swing trade really is, because we're going to be implementing an option strategy around this, the long put spread. But let's put that on the back burner for right now. We're going to talk about swing trades and really what is a swing trade. And ultimately, a swing trade lasts longer than 2 days, folks. A day trade is during the day. Swing trade is 2 days or longer, all right? So if you hold it overnight, basically you're involved in a swing trade. But what we are looking for in a swing trade is we look for markets that are doing something like this or sideways, right? We've seen markets do sideways trends or even bearish trends, right? And what we're trying to do here is ultimately discern whether this is a bullish, market neutral, or bearish trend, okay? And then after we determine that trend, we need to find resistances or support areas, okay? Resistances and support areas. I'll do a dotted line for these. Resistance and support areas, right? And then after we found those support and resistances, what we want to do is find when they come up and near those support and resistances, and then you look for the pattern within the trend. And this would be a bearish, we got a bullish trend with a bearish, with a little bear pattern inside of it. So you would be playing this to the downside. Here we got a sideways trend or neutral trend, right? With a bull pattern within that trend. Again, a bull pattern within a bearish trend, okay? So that's what we're first going to start looking for. And it's not necessarily a bearish pattern or a bearish trend with a bullish pattern. We're just looking for the trend and then the pattern within the trend, okay? That's really what I want you to take away from here. First thing you do is find the trend. Look for those support and resistances, and then find the pattern within the trend. It could be a bullish pattern and a bullish trend, okay? I just gave an example of a bullish trend with a bearish pattern. That's it, all right? And sometimes what we're going to see happen is when you have like that bullish trend with a bearish pattern, it might gap up or, sideways and drop back down, break below those supports. That will happen. That will happen with any trade, folks, is the trend will every once in a while break through a support and a resistance, okay? Or the pattern will break through the support and resistance. However you want to look at it, one of those two things could happen where the market kind of breaks out, where you could be looking at something like IBM with a perfect setup where you can easily see resistance, support. You can see that it is basically a neutral trend inside of a neutral trend with a bearish pattern kind of setting up right there, right? That's basically what we would be looking for is what you're looking for in swing trades, folks, is hammers like this at the top, at the very top or at the bottom of a move. You could also look at it from a perspective if it was flipped the other way at the, if it was at the bottom of a move and you got I think my marker going to work, pen. At the bottom of a move, if it was just inverted, that's kind of very similar. They have different names, but at the end of the day, those are key things to look for at the top of a move or at the bottom of the move. And it could even be something where it was a green candle at the top of a move, kind of like what we're seeing right there, where you get a green candle at the top of a move. Those are major trend type signals that we're looking, or pattern type signals that we're looking for inside of this trend, a pattern to start rolling over in a sense. So at the top of the move for that, or at the, either one will work, to be honest, even if this was at the bottom of a move, okay? So all of those types of candles are really significant. So if you're into or starting to get into like candlestick trading, those are key candles to look for at the top and at the bottom of moves. When they're inside of a move, like say for instance halfway in, it doesn't have as much strength behind it, okay? But if it is at a top of a move like what we're seeing here or here, those are the ones that we're going to be looking for, or a candle kind of like this at the bottom there, bad arrow, sorry. So look for those at the type of the moves. But when we've seen something trade sideways like this for a very long time, like IBM, yes, it will break out. We saw that's that candle that we thought was going to be a bearish move, got that move, but it blasted off to the upside. Now, you probably would have been out on the earnings. But what I'm saying is, now that it's even blasted off, like those examples I was talking about, sometimes it breaks out of that area. You can see it settled down and it's just getting comfortable at a new level. And, in the daily market commentaries, when these go wrong, I talk a little bit more in depth about how to manage this risk. But in something like this, if it had broken off and started creating a new trend, or a new trend sideways, then you would just try and stay mechanical with that trade that's going against you and lower your cost basis on it. Wait for it to have those pullbacks, just like you would with a regular trade. And then, so how do we swing trade? Well, we talked a little bit about this. And what we're going to do is first identify the trend, right? Check. Find the support resistances and then identify the pattern within the trend. This is the step that is going to be the thing that determines our directional assumption. We aren't looking at the overall trend right now in order to determine our overall strategy, because it could be a bullish trend with a bearish pattern, and we don't want to get bullish when it's starting to turn bearish, right? So this is ultimately that third step where we start looking to get involved with trading a strategy around that. But why are we going to use options? Because you're going to have much better odds or probabilities, but I don't want to write it all out. Probability is probably a better way to write it. And it will help you keep your powder dry when it doesn't always stay in that trend. It doesn't always find those support and resistances and start reverting. Sometimes it'll blow through those. And when it does, if you had on a position and it starts going against you in that stock, you are going to be a little bit more antsy. You're not going to be able to stay calm, all right? It's going to be a little bit more angst. But when you have options on it and you can rest on your laurels that you know that you've set the strategy up properly, which is what I'm doing in these webinars, is to streamline your process in order to do that. But ultimately, once you've done that, you know what your probabilities are of success. You don't always feel like that with a stock. It's about a 50-50 chance that you pick the exact right time to buy that stock, all right? So it's not always working out that way where you get into this underlying and it immediately starts working in your favor. It doesn't always do that with options either, but at least when it's with options, we either know what our risk was getting involved in it or our probabilities, and all of those things are going to help us stay focused, all right? If your mechanics start breaking down, that's when people start to panic, and that's when things start going wrong. The beauty in options is you've kind of laid out all of the game plan beforehand. You know your risk, you know your reward, and therefore, if something starts going against you, well, you knew what the probabilities were, okay? It allows you to get better strike location than you would normally do if you just went in there and bought the underlying. So what do we do? What happens, or why options? Because in situations like this, if we had high volatility, we could have been selling calls way up here. We have all of this wiggle room to get involved in a trade like that. So if I was short this underlying and it had popped up to this new level here, I would be a little bit worried. Yes, you can still lower your cost basis by layering some other option strategies or other strategies around it. But ultimately, if I had on a short call, I would not even have to worry that it had broken that pattern as much. Now, normally on swing trades, if it breaks that high, that's when you're supposed to get out of these. But with options, sometimes it will, sometimes with trading swing trades, I should say, it will break those. And then sooner or later, like a couple of days later, you start getting that correction. This really tells you the indication that it's losing momentum. All right. It's not a definite, but it's the probabilities of it losing momentum are much better. Now, we showed an example, this as an example of where it broke that. And that was one of those times where the probabilities beat us, where the probabilities were very small, and that happened. And that is something with any trading. Sometimes the probabilities turn on you. But if I had good strike location, a short call way up here at, say 140 calls, right? Something like that, and expected it to roll back over. Well, I had a lot of room to be wrong. I had two other resistance areas above me. So if I was short the stock, I would be getting out of this for a loss as soon as it broke that top. Yes, if you want to stick tight to swing trade rules, breaking above that wick would be something that would get you out. Now, I will set it up on those swing trades. And if I have a couple of support or resistances before my strike gets hit, I'm more than likely to allow that little bit of wiggle room to break off and maybe test that Fibonacci really go up there and hit it. And then wait for that revert back down. But the strike location with something like this, there's a lot of times where if you were short the stock versus or long the stock versus an option strategy, you just don't have that sense of calm. That's really what it boils down to. And the reason why is because of your strike location, knowing your probabilities, knowing the logic that I'm teaching you here to keep your, and knowing the probabilities, which will all help you stay sane and keep your powder dry. You will be more mechanical. You will trade better. All right. Again, here we have a bullish trend, right? And it looks like a bullish pattern within the trend. So those are ultimately what we're trying to do with some of these. Now, Boeing was giving me fits today. I love it when stocks gap out like that, all right? And with that type of hammer with a gap, really feels like it's just blown off a little too much steam and is going to roll back down to me. So anytime you get those gaps and that kind of, but then later on in the day, it stopped looking so great. So I pulled the ripcord on using this as an example. Late in the day, though, it started shaping up. I'm going to wait till tomorrow to see if that's confirmed, but I was looking at something like buying the 250 puts and then selling, I think it was like around the 205 puts for that trade. But I got rid of it when the market started rallying and found a better example. Because we've got tweezer tops here in Pepsi. You can see that's one of those dojis that we're looking for at the top of a move. Well, this isn't exactly one of those. It's not exactly that, but this is what we would call like a dark cloud, an engulfing pattern. When you engulf the previous day's pattern, you can see the momentum really slowing down. 2 days ago, we could see on Tuesday that the market really started slowing down. This is the wick I'm really concerned, or the one I'm really looking at. That was a signal of a top. No confirmation yesterday, but today, big engulfing candle. So this was one of those things where you would have been out on this candle if you had gotten set up here. The next day, you would have been out of it. Options, I would have been able to stay in it a little bit longer, I think. And then obviously you get that confirmation today. Well, this is the signal that I was waiting for in this trade, and we got it today. So this is the example I want to use for Pepsi. Coca-Cola, if you like trading Coca-Cola, yes and no, are they the same type of company? Not really. Pepsi is more in the snack food aisle, but they still have a tendency to kind of run hand in hand with each other. All right, so with this trade, I am looking at a bullish trend, right? It's a little bit fuzzy on, the overall pattern here, but to me, whoops, I wanted to make that look like it was rolling over. To me, it looks like the pattern is going to go down and at least test this level and possibly come down and test the Fibonacci, okay? But we do have a bullish overall trend, right? We found our support and resistances, and now I believe that the pattern within that trend is a bearish pattern within a bullish trend. So I'm looking for a bear trade. Okay. So, excuse me. I could go straight into this in short stock, but, I want to increase my probabilities of success. So let's talk about some options here real quick. What are options? The call buyer has the right but not the obligation to buy the stock. Now think about it. When you buy an option, you are buying a specific strike price. That strike price gives you the right to buy the stock at that price. All right. So if the stock is trading 100 and I buy the 105 calls, then that means, do I want to buy the stock at 105 when it's way up, when my strike's above the underlying? No, I can go out there and buy it on the open market. So I don't have to buy it there. Now, if it's trading 105, or if I have the 105 strike, right, and it's trading 120, do I want to buy it at 105 when it's trading 120? Yes. So then I would take my right, but not my obligation. All right. Now, the seller of the call has the obligation to deliver stock. All right. If I have the right to buy it, whoever sold it to me has to give it to me. All right. At that strike price. If I'm the buyer, I have the right to say. And if I say yes, then the stock gets sent over to me. Now, if I take that long stock into expiration, if it's out of the money, they know I don't want to buy it higher than what it is, okay, where it's currently at. But if it's below where the underlying is currently trading, in my example, I bought the 105 calls and it's trading 125 or something like that, they're going to assume, the exchanges are going to assume, if you hold that into the last day, going into the weekend, that you want to buy it at your strike price. So they're going to automatically assign you that without you saying anything. It's kind of like, if I don't do anything, I'm assuming you're assuming I want it. All right. So then it gets all offset. If it's out of the money, they won't do it. All right. A put buyer has the right, but not the obligation to sell that stock. All right. Call buyer has the right to buy the stock. The put buyer has the right to sell that stock. So again, if the underlying is trading at 150 and I own it's trading at 150 and I own the 200 puts, I have the right to sell it at 200. That's immensely valuable. Okay? So you have the right, but not the obligation. The put seller, on the other hand, has the obligation to buy it or take delivery. All right? Meaning if I buy the put, I say, you take it, and I just hand them over. All right? So call buyer is bullish. A put seller is bullish. Okay? Call seller is bearish. A put buyer is bearish. Okay? Different risks. Now think about it. If you are collecting a credit, you are taking on more risk, but you have higher probabilities of success usually. Whereas if you are the buyer, you have lower probabilities of success, but you have limited risk. So it's always a trade-off, risk versus reward. All right. If you're giving up something, you get something in return, or at least you should make it so. All right. How do we know if options are cheap or if they're expensive? We have to know this in order to determine our option strategy, because we're good stewards of our capital, right? I want to buy cheap and sell expensive. But when I'm looking over at the options, I need to look at these prices and say, Pepsi is either cheap or expensive. I mean, when I'm saying that, I'm talking about looking at all of these strikes. We're looking at the strikes in this column, and then look at all of the pricing, right? Are those 147 puts expensive or cheap? Well, what we need to do is look at this thing over here. It's called Vega. And it's actually called implied volatility. All right. So they're basically the same name. This number is implied volatility. All right. All of these numbers in this column are the implied volatility of that option contract. Okay. Now, what we need to do is find or look for these numbers, and really the numbers that are representative are closest to that 35, 45 days to expiration, right around in there is usually where the spot month starts rolling into. This is becoming the front month or the spot month as this one starts. People start rolling out of that June and into the July. So what we need to do is look at this number. Now, if you were to look at this number on Tesla, it's going to be something like 60, 70. All right. So with Pepsi, it never gets up to 60 or 70. As a matter of fact, what we're doing is we go over to this chart. We know that this is our chart where we've got our bullish trend with a bearish pattern. And then we want to come down here and look at implied volatility. And I have it as a chart. I also have a script to only give you basically the last 6 months, kind of get rid of some of that old noise we had from last year. So, and you guys can reach out to us at Pro Trader Strategies if you want to get that. So implied volatility, there's that 18 number. We were seeing that show up over there in the front month. It's really close to this, right around that 18. So that's really what this number is telling us, is basically somewhere in that spot month between that 22 days and that 50 days is implied volatility is ranging right around 18.5%. All right, and that's what this number is. So what we need to determine, because we know that implied volatility for a specific underlying acts like a swing trade, a neutral swing trade, where they have a resistance and a support level kind of embedded in them. And what we do is we try to find those areas of support and resistance, because that's the range. Now we want to determine where we are right now within that range. So when we're looking at this point here, you can always tell between this line and basically this line, we are closer to the bottom. All right, so that's your first indication that it is, those options premiums are pretty cheap. Okay, so just look at where we are right now within that range. And if we zoom in on it, we could go in here and say that, let's just say that this is like 31, the low here, let's call it right around 17. Let's just say 17 for math purposes. And we'll just call it 18. All right, just for simple math. All right, so basically we need to take the current implied volatility, which is this number, right, minus the low implied volatility. We take that sum and divide it by the high IV minus the low IV. Okay. Basically what we're trying to do is find this current between this range. Okay. So we're going to take the current, which is 18 minus the 17, right? Do that. We got 1. And divide that by the difference between the high and the low. That gives us 14. So we are looking right around, what is that? You guys are going to have to help me out here. It looks like it's 0.08 or something. Let's pull up the calculator. So got 1 divided by 14. May throw it over there yet. 7%. So it's in the 7th percentile. So if you want to get the nitty gritty, look at the numbers, you know, you could come up with different types of ideas. But what I like to say is when we are below, it's a buy. And when we are above, it's a sell. Being this is the 50 line, 50%, right? 50% between there and there. Okay. So what we usually see is when volatility is at extreme lows, it wants to start reverting back. It doesn't always come down and touch the line, but it does have a tendency to start reverting back. So yeah, it might come out 1 or 2 percentage points. That's okay. I'm going to be looking for this to start reverting back higher. And because I have a bearish assumption here, bearish moves, generally speaking, will see volatility increase because it's people will go out there and buy options for protection. Just recently, though, we saw like the Gilead science fall out of bed and volatility actually came out. So it doesn't always happen that way. But what we're trying to do is think logically here. We are at extreme lows in this volatility. The likelihood that it moves higher is much greater than the likelihood of it going much lower than this, okay? Because they have a tendency to be stuck in this range. Those are some of those givens we're looking for, all right? So in this case, we could easily say that the prices in the option montage are cheap based on where implied volatility is currently in relation to where it's been in the past. We just we don't have to look at the specific dollar amount, folks. What we need to do is look at the volatility, because volatility, as it goes up and down, makes our prices in our options fluctuate. So when volatility is really low, that means there's almost no volatility embedded in those options, meaning the pricing is cheap. If volatility goes up, that means volatility is getting put into those premiums, and those premiums start getting very expensive. All right. So when options are cheap, we want to buy options. We're good stewards of our capital, right? All right. So something we have to consider is this thief in the night. We already talked about volatility, right? As volatility fluctuates, our premiums fluctuate. If volatility is at its extreme high, we know that our prices are at extremely rich. And when it's at extreme lows, we know that they are extremely cheap. Now, the thief in the night is how I remember it from the floor. The thief in the night that comes and steals our premiums is what it really amounts to. And what we can see happen is look at the theta column. It doesn't matter if you're looking at the calls or the puts. These are the calls over here, the puts over here. Remember our strikes all the way down the line, all right? And, you know, they're correlated to both straight across, all right? So let's look at this theta number. Inside of the 23 days to expiration on this, you can see theta is around 13 cents. Now, right around where we are here, 50 plus days to expiration, look at theta now. It's only 8 cents a night. Now, remember, when we're looking at options contracts, all right, for one thing, every option contract is equivalent, every one contract is equivalent to 100 of the underlying. Right? So if you went out and bought 100 of the underlying, right, you got to multiply that price times 100. Well, in options, you have to multiply these prices and all of the components by 100 because each option contract is equivalent to 100 of that underlying. Does that make sense? So for instance, this particular example, that offer is 568. This is 12 cents or $12 a night. So that starts becoming a little bit more pricey, right? Well, if you went out 50 some days, it's only $8 a night. If you went out 80 some days, it's only $7 a night. So between 80 and 70, we only lost $1 more than when we first got into this trade, all right? Whereas if we had gotten in here, those next 30 days, we would have gone from like 8 or 9 cents to 12 or 13 cents. That would have increased by about what? 4 or 5 cents or $4 or $5 really, right? So if we are buying options, we want to limit the thief, all right? So the way to limit the thief is to go out further in time, all right? And what I like to say is when we're looking at further out in time, this is like right in here, right around 45 days. This is your buy zone. Or I hope I don't start doing this again. This is your sell zone. I did this at one other webinar, and I started getting. This is your buy zone. All right, you buy out here, outside of like 70 days to expiration. Here, this is what happens to our premiums. Look how fast they go down. You lose almost 50% of your premiums from here to 7 days to go, basically. All right, 50% of your premiums are going to decay. So that's why we go way out here. We limit it. As a matter of fact, if you want to go further out in time, that kind of flattens out a little bit more even. So this isn't a linear erosion. It's not 7 cents every single day. All right. It's 7 cents today. It's 7.1 cents tomorrow. Stuff like that. Okay. So it's going to slowly increase, but it really starts ratcheting up inside of this 35 days to expiration. So we want to sell if we were selling or collecting a credit. And if we're thinking about buying or doing a debit spread, we need to be thinking further out in time. Limit some of those negative effects of theta that is going to come in and kind of maul our premiums that we talked about there. All right. So another thing we're talking about here, swing trades with the long put spread. Why would I choose the long put spread? Well, for one, it's basically you're going to limit your risk a little bit, all right? So if you're newer to trading options, I would suggest going with the long put spread before you go on to maybe just a long put, okay? This will help you stay mechanical. You're going to lower your overall cost base. You're going to have a little bit less risk. You're going to have a little bit less reward, but you're going to have a little bit less risk on this trade, okay? But there's two ways to set this strategy up. One is to go to around the 84 delta, all right? Now, the 84 delta is basically the one standard deviation. So if we're thinking about this side is the calls and this side is the puts, right? Well, right here is basically zero. That's right there at the money where the underlying is trading. But if I'm going to buy an in-the-money put, that means it's basically on this side of the equation, okay? So if I'm buying an in-the-money put, basically I'm looking at a one standard deviation, all right, put that I'm buying. So I would buy the 84 delta or 84% probability put, okay? Because these are all probabilities of something happen. That's what happens with the standard deviation curve. It tells us the probabilities, right? One standard deviation move. That means that this is about a 16% probability of happening. All of this is an 84% probability of happening. Okay? So if you're going to pick the in-the-money one, all right, and that's the one that's going to be a little bit more expensive. It's not my favorite, folks. But if I thought that I was worried about this underlying, right, we've had a move to the upside. I'm expecting a rollover. If I'm worried about this underlying kind of trading sideways like that before it moves to the downside for whatever reason, maybe it's gotten back to gotten back to the point of control or something like that. But if you think it's going to settle down for a minute, then I would lean towards the in-the-money put spread, okay? The reason why is because if I do the in-the-money put spread, I can limit my theta decay, all right? I still have to be bullish. I cannot really have this underlying go against me. I don't want it to go, I don't want to start moving up, really. I want it to at least trade sideways to down with the in-the-money put spread, okay? So we'd be selling an in-the-money put spread, we'd be buying the in-the-money at the 84 put, and then we're going to be selling right around the 16 standard deviation, the 16%, which equals the one standard deviation move, all right? Because if you add up all of these probabilities here, all the way out the line, you're going to end up adding up right around to 16%. Okay, so when we're looking at the standard deviation curve, we're looking at it as percent. But Our deltas are just the standard deviation probabilities, folks. So when you're looking at a 16 delta, that means it's a 16% probability of being in the money at expiration, right? An 84 delta is an 84% probability of being 1 penny in the money. Okay, that's the key though, folks. 1 penny in the money. That doesn't mean you haven't lost money. It means you probably have lost money, but it just means that it's going to finish at least 1 penny in the money. All right. So with the put spread that's in the money, we want to do around the 84 delta, but this one here needs to pay for all of our extrinsic value or that theta. And I'm going to show you how to spot that quickly. Otherwise, you're going to go right here at around the 50 delta. I'm going to buy that 50 delta put, and then I'm going to sell an out of the money put to help pay for some of the cost of this transaction. So delta not only tells us the probability, most people tell us it's the rate of change to the option premiums, meaning for every dollar the underlying moves, then our premiums will adjust by the corresponding delta, right? So for instance, if I'm looking at an option montage, that means, for instance, if let's look at the calls just for sake of simplicity here. If this underlying, if I'm looking at the 150 calls, right, the 150 calls, if this underlying moves up to 148.43, okay, that's $1 increase, right? It increased by $1. If it increases by $1, the underlying, my delta is going to add into those premiums for a dollar move higher. So it would increase by 40 cents, right? That I usually kind of breeze over a little bit. We're going to talk about that a little bit more today and how we look at these two different spreads, the one that's in the money versus the one that is out of the money. Okay, but these also, back to the probabilities, for instance, this is saying there's only a 7% chance of the corresponding call to be in the money at expiration. So 165, there's only a 7% chance that Pepsi is going to be trading 165.01 in 85 days. All right, finish 1 penny in the money at expiration. There's only a 7% chance of that happening. During the life of this 85 days, there's about a 14% chance. 2 times the delta is your probabilities of being tested during the life of this option. Now know that the delta tells you the probability of being 1 penny in the money at expiration. That day closes, you're at least 1 penny in the money. That's an 84% probability. 16% probability, or 14% probability on these, because the underlying could come up there and trade 165 and come back down. All right, so there's a better probability it gets hit than settles in the money. Something to make sure you know, because I am not trying, if I do this spread, I'm not waiting for my short put to finish in the money. I'm not looking for that type of trade. I'm looking for it to just come down there, hit that strike, and then I pull the ripcord. That's when I get up. All right, so let's talk about the strikes. Long put spread. If you're doing the in the money, this is that 84 delta. The at the money, you're looking at around the 50 delta. All right. Now, if you're using the 84 delta, all right, you want to risk $1 to make $1. All right, risk 1 to make 1. All right, if you're using the 50 delta, you want to risk $1 to make $2. So basically, it's a third the width of the spread, right? So it's $1 wide. I'm risking 33 cents to make 67 cents. Okay, risk 1 to make 2. That's how you set that up. Whatever your debit is your risk, and then whatever the remaining width of that spread is your reward if it were to work out. Okay. So we want to make sure we pick one of those. If you're picking the 84 delta, you're kind of worried about a sideways trend for a little bit before we resume a downward trend again. All right, that would be something where you're just a little bit concerned about. If you're doing the 50 delta, you want this market to make a move quickly. All right, maybe you've got a nice confirmation like the one in Pepsi or something like that. You've gotten the confirmation, then that's what you're looking at. 84 delta, maybe you haven't necessarily gotten a real clean confirmation yet for that, but you feel like it's topping out, something like that. So take this into account. What do I think is going to happen? Do I think it's an immediate correction? I'm going for the 50 delta. If I think that it might stall out a bit, I'm not worried about it rallying. I'm only worried about the downside, but I'm worried about it hanging out here for a minute. I'd probably lean towards the 84 delta because then I can eliminate the theta decay. All right, so let's take a couple of examples and look at real life trades that we could have done. Let me erase all this stuff because I was talking about something different here. All right, so here we're looking at the monies, right? It's slightly in the money when I did this, but you can see it was just slightly lower than that. So it's really close to the at the monies. So I'm looking at the 150s and the 135s, buying these, selling these, right? Now, when I build it out, I do it for a $5.14 credit or debit, and it's $15 wide. That's that third the width of the spread, right? Or risk one, I'm risking $5 to make $10, right? Because the whole width is 15. If I get that whole width, I would be selling this strategy out for $15 if I nailed it on the number, right? But I'm going to be getting out as soon as this bad boy is trading right around 10, right? 50% or basically doubles is what I'm looking for, all right? I'm not looking for that triple. If doubles goes to 10, that's where I'm going to look to get out. And that would be when it hits that 135, I can almost assure you. It's going to be right down there in and around that level. Now, if you were worried about the charts and Pepsi kind of like stalling out here, then you would look for that 160 put. You know, it's not always going to give you that exact delta of 84, folks. You're just looking for the one that is as close to that as you can find. Now, we're buying an in-the-money option. Something I told you, we want to pay off that extrinsic value or that theta decay, whatever is going to erode, right? Well, an easy way to do that is literally just look over at the corresponding puts and or the corresponding option, and that gives you where very close to what the extrinsic value or the theta decay of that option will be. So what you want to do then, after you figured out your strike, I'm looking for as close to that 84 delta as I can. I immediately just glance over. All right, 74 cents. That's telling me how much I need to pay off. Well, that gives me the 130 because the 125s don't do that, do they? The 125 puts are only 60 cents. They wouldn't have paid off all of the extrinsic value. So I go to the 130s. On this one, we're risking one to make one. Well, I actually at least risk one to make one. I don't want to pay 60% the width of the spread. But in this case, you can see I did slightly less than 50% the width of the spread. $15 would have been 50%. So, you know, 44-ish, something like that. So that is a green light to go for. So either one of those. This one right here, I am worried about a stall out. The underlying kind of troughing out right there at that Fibonacci we showed in the chart. Here, I'll pull it up again real quick. Just to kind of one more time go over what we're looking at here. I've got these tweezer tops, right? So for me, if you're doing this as a swing trade and it breaks through this, even for me with options, I'd probably be covering that. I'm going to write that down. I'm out above this area because that will make me stay mechanical, folks. If you write this stuff down, why you got in, what all of the details were, you know, as a sideways trend, pattern, put it all together so that you can go back and kind of put yourself in the same mindset as you were when you put the trade on. Because things change as the trade goes on. And to stay focused and stay mechanical, you need to kind of go back and look at what you were intending to have happen. Breaks above this, I'm out. And when you see it and it's written down, you're more likely to stay mechanical and do what you said, rather than if it's just in your head and you're thinking about it, you're kind of, I'll wait a day or two. All right. If you write it down, you're holding yourself accountable. All right. So I've got this big candle engulfing here. I don't remember why I was coming up with this. We know we've got really low implied volatility. If I was worried about it stalling out right here, that's when I'm going to be looking at that 84 delta put. All right. But for me, I'm going to be looking at just getting out of here when the market starts. You know, I'm going to be looking at very close to the at the monies on this, because I think that we are going to see this rollover happen quickly and start moving back down to the 78 Fibonacci here, which is lined up right around with what, at least 144-ish. So I will definitely be looking like those 130s will be tested, which is kind of a little bit further down here. But this type of move down to this point of control, I'd be more than happy to get out of that trade too. But if it comes down and slams my 130s, I am for sure out on those trades. Okay. But this is the one that I'm going to be, this is the trade I'm going to be looking at for tomorrow, is somewhere probably closer to these 145s now that we've sold off. But originally, this trade was what I was looking at, the 150 to the 135. That would get me back into that point of control. Another reason why I'm kind of leaning towards this trade, because I want my short strike to be tested, because that's when you're going to get your best bang for your buck. So this is the one that I would be looking to do, because I think that we're going to get this rollover faster. Now, if I thought it wasn't going to happen as quickly, I'd probably look to go to that in the money option so that I could pay off some of that extrinsic value. All right. So when do I get out? This is the key, right? When your short strike is breached, no matter what, if that short put is breached or test hit, that's when you're pulling the ripcord on it. I don't care if you have 50% increase in what you paid for it or any of that. Just get out as soon as that short strike is breached. Don't think about how much your return on investment and all of that stuff, and you've got to hit that mile marker or whatever. Don't. If it hits your short strike, you beat the probabilities, get out. So on the one where I'm risking one to make two, all right, I'm looking for my price to double. So I pay $5. I'm looking to get out at $10. On the 84 delta one, remember I'm risking one to make one. Well, I'm basically on the 84 delta, I'm just going to multiply my price or my debit here. So multiply the 84 delta. We're going to multiply the debit times the I lost my train of thought. Debit times 1.33, because we were trying to figure out our exit, or a 33% increase in our premiums, or 1.33. So, you know, like if I paid $50 to make $50, it increases by 33%. It's basically looking to get out when I'm trading right around, what is that, 65? No, right around 70. Okay. So it increases to around 70, 75, 70. That's probably where I'm looking to get out on the 84 delta. Increases by 33%. On the 50 delta, we're basically taking the debit. We're taking the debit times 2, or double it 100. You know, it doubles. All right. On an exit, it's defined risk strategy, folks. If I was looking at this 84 delta on this Pepsi trade, it breaks above that tweezer top, I'm out of it for sure. On this chart setup, I'm out of it if it breaks above this tweezer top. Tweezer tops get broken, it's off to the races. Usually tweezer tops are a very good sign for a rollover though. But it breaks that top, I'm out of it. Usually with the 50 delta put spread, you didn't put a whole lot of money up for this, so I'm usually going to let it breathe a little bit. That's why I was talking about, you know, that angst breaks tweezer tops. You know, you were short the stock, you probably want to get out of it. Well, some people with this 50 delta debit spread would be like, I only put like you know, $5 up for it or $500 to make, you know, triple that, I'm out. I don't care. I'm just going to let it ride. And I've done that before, and it's turned around and worked out. We saw what happened with Boeing just today. I talked about it in the daily market commentary. All right. Anybody else have any other questions on this trade? How we're going to set this up? If it's an in-the-money option, you're using the 84 delta, and you're probably using it right around that 16 delta. You can see I had to go a little bit further out than the 16 delta there. But I'm risking one to make one, at least. Risk one to make one. I'm risking a little less than one to make a little bit more than one, so that's okay. That works. And in this one, I wanted to try, when it's at the money, risk one to make two. Now, there's a lot of people, I almost cut this off and forgot about it. This is super important, so I hope everybody's sticking around for this. Now, a lot of people will hardline that 84 delta in the money option, okay? And the reason why they do that is because of the probabilities of being in the money, all right? But if I'm looking at this one that is in the money here, right? This is the in the money one. So it's $13 for this in the money one. And if we talk about the deltas, right? We got an 86 delta and a 12 delta. That means I'm buying a negative 86 delta, right? And I'm selling a negative 12 delta. Well, these two offset, right? So this then becomes a negative 74 delta, right? Means I make 74 cents for every dollar moved down, right? Well, if I'm looking at the pricing being right around $13 here, and I go to this one, all right, so 74 cents for every dollar move. Remember that one. Now we go over to this one where it's the at the monies, right? And I've got a 60 delta, so I'm buying a negative 60 delta, and I'm selling a negative 18 delta, right? So basically the difference here is those make that a positive, right? So now I'm looking at about a 42 delta, right? 42 delta, is that right? Did I do the math right there? 42 delta, final answer. All right, so now this strategy increases by 42 cents for every dollar. What's everybody doing right now? What's everybody thinking? This at the money strategy isn't going to work as well as the other one, right? It's only going to increase by 42 cents for every dollar. This one increases by 74 cents for every dollar on a one lot, right? Well, here we're risking $13, so your risk is more and your reward is going to be commensurate, right? You risk more, you're going to make more on this trade. Well, is there a way to switch this thing around a little bit? Well, if I'm only risking $5 here, some people go that in the money one. Well, if you can pay, if you have enough money to buy that 84 delta, well, why not consider the 50 or the right there at the money one and do two of them, right? This is $5.14. I bought and changed this to a two lot, right? Now I ultimately, for each strategy, I'm only paying $5, but if I do two of them, I do a total of, it's going to cost me $10.28, right? Two times this. And option contract multiplier. I'm just trying to keep apples to apples here. So this would be $10 if I do two of them, 28, right? The other one is $13.37. But now I'm doing two times that delta, right? Because I'm doing two contracts. Now I get 84 delta for every dollar move. And I'm risking less. Right? Does that make sense? So if you're ever in a conundrum, it's a little bit better to lean towards that 50 delta. If the underlying goes against you, you're still, you're going to lose money either way up to the 84 delta or the 50 delta. But if you're looking at it from apples to apples and you want to just, you're only willing to spend this much, like it's, you know, I don't mind paying $13 for a trade or risking $1,300. Well, then I would look at doing 2 of these then in that case. And then when the market starts rolling over like that, these 84 deltas, those extra $12 well, every time the underlying moves $1, you're going to get $12 extra in your portfolio. Isn't it the same deltas regardless of number of contracts? Yes and no. It is the same number of deltas in the sense of this, but for every dollar the underlying goes up, each one is going to increase by 42, right? But what I'm saying here is the overall position, right? My overall position, if the underlying moves higher by $1, my overall position here is going to increase by 84 cents, right? Because for every delta tells us for every dollar move higher, our position is going to adjust by that dollar or by our delta, right? So if the underlying moves higher by $1, each one contract or each one spread is going to increase by 42 cents, but I've got 2 of them on, so that's 80, right? Yes, it's kind of like a 2-for-1 sale. But when you start building out these deltas, you know, I'm going to actually get more bang for my buck with this strategy, doing 2 versus 1 that's in the money. So usually I will lean towards this strategy, the 50 delta, more so than the 84 delta. 84 delta is still on the docket if I'm worried about the underlying doing a sideways move like that and then coming off. You know, that's the only time I would worry about that. All right, we're going to maybe pause. Maybe it's moved up to another level and it's paused out there and you think it might, like IBM is going to stay at that higher level a little bit longer, possibly. Your real objective is it to come back down to the previous trend area. Okay. Does that make sense? How I'm laying out why you would pick one or the other? Is everybody pretty clear on that? Because that was a point that I forgot to mention on the long call spread. So that's why it's great for you guys to watch all of these, because sometimes I forget to mention something in one of them. You guys drive the content, so we start all, you guys get the levers and pulleys working in my brain. All right. Well, there's no other questions then. You guys, this is the offer I'm going to give you guys all today. It's over in the chat window right now. If you're watching on tape delay, you're going to obviously have to pause. This is not a hot link coming through. You're going to have to pause, punch this into your URL. And I don't know why that is on there, because that's not the link. What happened here? Didn't say it. Give me a second. Let me find the thing. You guys are going to, everybody's like, I don't want to wait around. I wish I could pause this real quick. See if I could do it, but I don't think it's going to work out. Where is it? Come on, think fast. Go to this one. See if I can get it. All right, here you go. All right. This is it. The options course, folks. Basically, you're going to be able to set up your screen like me very easily. Also, if you guys take advantage of this, I will send you the script to throw over in a watch list that will give you the implied volatility percent or the rank or whatever you want to call it, that number we were figuring out with the current versus the range for the last 6 months. You know, the last year and a half, we've had volatility all over the board. Where we're going to settle out is going to be determined, right? So where we were a year ago, we're not really in the same place we were. So that volatility coefficient could be different. So I'm taking a look at the last 6 months. I've written a script for that so you guys can take advantage of that. Also, all of these other fun ones as well. We got history of options, market profile trading. You know, that's going to help you out with swing trading as well. So you can take advantage of all those. Like I said, the URL link is right there, or how to trade options like the Wolfman, you can click on that. Finally, take a moment to go over our disclaimer, as we are an educational company. I'm not trying to get you guys to do these trades. I'm just trying to use these as examples for you guys so that you can implement them into your portfolio in your own way. Like I said, thank you guys all. I appreciate your time. One last thing, smash that like button down to the bottom. It really does help out. And if you can't smash that, take that. All right. Bye for now, you folks. Take it easy. Have a good weekend, you guys. You too, JQ. Bye for now. I did, JQ. I changed it up. You're right. The smash that. That's the new one. Smash that or take that. Which one's better? Take that or take it easy, or smash that or take that?